Good afternoon, Wealth Our Way Nation. What is going on? It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. Welcome to episode 12. And we are covering the importance of leverage today. We are continuing the series on leverage, debt, and credit. I'd like to thank each and every one of you who are with me live as we stream across our Facebook Wealth Our Way page and our YouTube Wealth Our Way page. I also want to say, boom, special shout out and salute to Wealth Our Way Nation who watches this program pre-recorded overnight, over the weekends, or wherever you can squeeze 15 minutes of financial literacy in. And a special, last but not least, shout out to the good people on the Life 101 platform who listen to the audio of this program. So, as I promised you, we are going to delve deeply this week into the importance of credit, leverage, debt, why in underserved communities it has been such a plague and a hindrance to financial growth and success to be shut out of access to leverage, credit, debt. And I want to talk some pointers today on why it is important and why it is necessary to access the capital and credit markets. I hear way too often in my financial travels where people are taught to be afraid of credit. They're taught of the trouble that they can get into with credit. Well, just like the very misquoted line from the Bible where people misquote and say money is the root of all evil, the proper quote from the Bible is the love of money is the root of all evil. I've heard similar statements about money being a good servant, but a horrible master. The reality is that being in debt for foolish purchases, assets that depreciate in value, using debt to take speculative chances where the risk far outstrips the return. Yes, those are detrimental activities. I do not endorse them, and I would caution you against partaking in them. However, there are very great opportunities to profit handsomely from the proper use of debt, in particularly leverage. As we talked about yesterday, let's revisit the difference between debt for debt's sake and leverage. Debt for debt's sake is just is borrowing money that you will use for anything that you see fit, and it doesn't necessarily have to be a prudent financial decision. As opposed to leverage. Leverage is debt that you take on, that you immediately plan to take the proceeds that you have borrowed and deploy them in such a way that you are getting an appreciable asset. I'll give you an example. This may be talking a little over the heads of some of you in the audience, and I always encourage you to put a comment in the comment box and ask me for a little more clarification if something sounds crazy. This particular example I'm going to give you is something that I do for my high net worth clients, my clients that have assets of over $1 million and net worths north of $3 million to $5 million. What these clients are normally looking to do is to mitigate taxes, lower their tax burden while they're alive, and when they pass on, making sure that their assets that they pass to their heirs aren't completely decimated from taxation. A lot of times these clients choose to purchase life insurance policies that will allow them to have the tax-free growth and tax-free transfer of monies to their heirs that life insurance provides. If you could imagine buying a life insurance policy that may have a death benefit of $5 million and you're a 50, 60-year-old person. Now, just think about it. Life insurance is a product that is based on two factors, health and age, mainly. There's some other minor factors, but health and age. So the older you get, the more it costs. 60 isn't necessarily old. I don't want to believe it's old because I'm 51, so I'll be 60 in less than a decade, high 60. But 60 is not 20. 60 is not 30. So the cost of life insurance for a 60-year-old is higher. Now, What are you actually buying? You're buying a death benefit. The higher that death benefit is, the more this thing costs. So now you have a 60-year-old trying to buy a $5 million death benefit. Lastly, if they want a permanent life insurance policy as opposed to a term policy, it's going to be even more. So the monthly requirement, the premium required to buy a policy like that could be $15,000 a month, some crazy number. But once again, if this person is prepared to pay $15,000 a month, which times 12 is $180,000 a year for the next 20 years, they're thinking of paying $3.6 million out of their pocket so that their family can get $5 million tax-free. There's some value in that, in their planning. Now, imagine if that person didn't have to pay the whole $18,000. If they could get that exact same policy through the use of leverage and only be required to pay maybe $5,000 a month, and they could borrow the difference, and the interest on the loan that they are using can be paid back out of the insurance policy. I have helped clients do that time and time again. It's a function called premium financing. Once again, I'm using it to show an example of leverage, not for you guys to get your Google out and try to figure out how you can do a premium finance life insurance policy when we're still trying to get Roth IRAs funded. So let's not start tripping. But the point of the matter is that there are always things that we can do financially to better ourselves. If we can do it with $1 of our money, how much better would it be if we could do it with $5? And the reality is sometimes we don't have the $5, but there are institutions, there are opportunities that will lend us the other $4. That is leverage. For way too long in the underserved communities that I seek to help and to inform, these processes have not been made available. No one has been made aware of them. If you are borrowing money to purchase something that is going to be worth more in the future, that is a good reason to borrow money. If you're borrowing money to buy tickets to go see Beyonce or to get a new pair of Air Jordans, that is not a good reason to borrow money. Leverage is how businesses, how governments, how wealthy people grow their wealth. There is a term, OPM is the acronym, other people's money. Other people's money is how all great wealth is accumulated. It is very, very difficult. The odds are seriously against you to build a fortune going dollar for dollar with your own money. That is why you hear terms such as debt financing, debt structuring. The United States of America, which is the economic global superpower, has more debt than any other nation. Our debt exceeds the per capita debt of every, not combined, but individually, every other nation, because we understand the importance of that leverage. By issuing that debt, getting that capital, we are a superpower. We can deploy that capital and get a higher rate of return than if we didn't borrow the money. The same thing with financial institutions, namely insurance companies. Insurance companies take in the premium dollars that they charge, and then they deploy those dollars into investments, and they pay dividends back to their shareholders, back to their policy owners, if they're a mutual company, to leverage the amount of money that they have now taken in. So it's always going to be a multiplier of the money that comes in hand. I use the example of getting a mortgage. That is, for most of us, a simple goal that we should all be shooting for, whether it's to own a home that we're going to live in or own a home as an investment property. Once again, we do not normally walk up to a house, see that it's $200,000, $300,000, $400,000, look at our bank account, grab every dime of that, and pay for the house cash. That is very seldom the way houses get purchased. What we do is we leverage our existing money. We say, I have 3%, 5%, 15%, 20% of the value of this house. I can put that down on the house and borrow the rest of the money. That is a leverage of your capital. And by using that leverage, now let's just use the example of a $200,000 house. and you having 5% to put down. So you have $10,000. You go ahead and you put it down, and you now have a mortgage for $190,000. Let's say that mortgage is costing you 3% a year or 4%. I don't care what the percentage is. That percent, though, is less than what you would earn if you bought the S&P 500 index fund or ETF and let it grow tax-free inside of your Roth IRA. So if you had a choice, if somebody gave you a bonus at work or a relative passed away and you got an inheritance and you got $50,000 in your possession, this is a call I get a whole lot. Tank, I just got some money I wasn't expecting. Should I pay down my bills or should I grow my assets? I would tell you in the example of that mortgage, you would be better served putting that money into a diversified portfolio of ETFs, seeking a return of between 6 and 10%, depending on the level of risk you're comfortable with, and continuing to pay on the debt that's only costing you 3 or 4%. That difference between the cost of the debt and the return that you're making is known as a spread. And the healthier the spread, the bigger the spread, the more you are growing your wealth over time. See, this is something that I have to help my community get over. I have talked to people who have had hundreds of thousands of dollars in the bank. Right now, even though interest rates have ticked up a little bit, bank accounts aren't paying you any money to leave money in the bank. Less than 1%, less than 1/2 of 1%. But we have a stigma, a lot of us in our community, that says, as long as I see that money in the bank and it can't go away, it can't go down in value, I'm doing good. This is the very mindset that helps broaden the racial wealth gap. Because we as Blacks, African Americans, Haitian Americans, whatever we want to call ourselves, we as Black people in the underserved communities that I am speaking to, we don't adhere to, or we're just not aware of the financial tools that are at our disposal to make the money work better for us. We are so into security, a CD, a bank account, and not into an equity account like an S&P 500 fund. And as a result, you are paying debts, because when we get in trouble, we go get a credit card with 12, 14, 19% interest rate. We have no problem with that type of debt coming into our picture, but we will not take our money and make it work harder for us. We are losing the leverage game. When you think about the racial wealth gap and the fact that it's widening over time, there was a study out that says by 2053, there will be absolutely a zero net worth in the Black community. That's the most ridiculous thing after all of the opportunities that we have been presented with in this country. Is there still a fight? Is there still an uphill battle? Is there still obstacles and discrimination? 100% there are. But are we able to make capital in ways that we have never been able to before? 100% there are. As a result of that, to watch something continue to grow and get wider and wider apart because we are paying more money out than we are growing in, I can't see that continue to happen. That is why Wealth Our Way exists. That is why I come on here every day at 12:30 to give you guys the tools to realize we can make subtle, small change that once we add momentum and time to our changes, we can have a better life for ourselves and, more importantly, our children and our grandchildren, because we need time on our side. Have the mainstream Americans, I don't like to use color terms unless I'm talking about me as a Black person, but has mainstream America gotten a tremendous head start on us? Yes, they have. Is there an opportunity to still close the racial wealth gap by being better stewards of our monies, being better investors, being less spenders? Yes, there is. So I encourage you to get a firm understanding of these tools. And that is why I'm talking about the importance of leverage, credit, and debt this week. So I will continue with this lesson tomorrow. I think I'll be wrapping it up tomorrow. I want to encourage you guys to always do your own homework and research. Come back with any questions, concerns, or comments that you have tomorrow. Also, there's a lot of helpful tips in that book, 5 Major Money Moves and 3 Money Must-Dos. And I cannot wait to talk to you guys tomorrow. So by all means, remember our motto here at Wealth Our Way. Wealth is not only for the wealthy. Have a great day.